Hi everyone. We have TAGC President Venkat Kanugunti, and then we have Krishna Rangaraju from New York Life, and as well as Rai from Tax and Wealth Financial Wellness expert. So please, Venkat Garu, can you please start the introduction of our experts?
Sure. Thanks, Srikanth. Thank you, Krishna Rangaraj Garu. Thanks you, Roy Vogees, for joining us today on a special day. I know everyone is celebrating Valentine's Day. We thought we would use this as an excuse to educate our community, our Indian community, Telugu community, and everyone to tell about few things. Again, taxes, insurance, probably not the right word to say it, but how do you want to take care of your family, your loved ones on this special day? That's the main theme we want to start with. And of course, we got well distinguished speakers on that one. Both Krishna Rangaraju and Roy, again, had helped our Chicago community for a long time. I can't speak how many years I can think of, but easily more than 15 years I know of personally. But I will let them introduce themselves. But again, Krishna being in the Chicago community, Roy, I know physically you are not there, but your office still helps a lot of Chicago community still. Again, thank you for that help. For again, also being a long-term TGC, one of the sponsors also. Thank you. Krishna, can you introduce yourself?
Yeah, this is most of you may be knowing. Hi, all viewers, and good evening, and happy Valentine's Day to you all. As introduced by Venkat Gunuganti, President, Telugu Association of Greater Chicago. I am Krishna Rangaraju. I help the community with insurance and financial planning needs. Particularly, most of the time, it is life insurance. And the main, I work for New York Life. My primary practice is there with New York Life. And but also I broker business with many other companies like AIG, Transamerica, Prudential, Banner Life, so many other companies. To name few, I told you. But my main practice is with New York Life. And I've been helping the clients in the community for more than 28 years. Back home, also I was in management in LIC of India. That's how I started my career in LIC of India. I was manager there and married to a software engineer girl and came here. And after getting the work permit, I joined back to the same kind of profession, helping the community with insurance needs. So what I advise always, of course, protect your family. And being Valentine's Day today, while you are celebrating your Valentine's Day with your loved ones, you protect your love for future, your loved ones for future, the love and dreams you have today. What I do is you can dream of anything with your loved one today. But what I do in this kind of situation is I protect your dreams, the dreams which you are making today with your loved ones. What I do is I will protect those dreams, whether you are somebody unfortunate events or you are living longer. From today, you are living, for example, anybody, something happens, unfortunate event happens tomorrow, or somebody may live for 100 years, of course we wish. So whatever dreams you have from tomorrow to what if something happens tomorrow to what if you live for 100 years, that is where I plan total your 40, 50, 60, 70 years of life. Somebody who is 21 years old, a kid, then we can start protecting their dreams from 3 weeks of their birth. So from there to as long as 100 or more than 100 years. Actually, nowadays the insurance companies are protecting the life. They are providing insurance till what if somebody makes more than 100? Yes, there is still insurance, permanent insurance till up to 121 years. Generally, that is the highest any company has today because the longevity is going up every time. Earlier, the longevity used to be 75 or 76 years, even in United States. Now it is about 85 years. So protecting for long term has become a major issue now. So as that longevity is going up, the insurance companies are also coming up with new products which can protect the life forever. But to tell,
just give a chance to Roy also to introduce, and then we can come back to you.
Sure.
Hello everyone. My name is Roy Vogees, and I am based out of Dallas, Texas. Here, I have always been in Chicago for a long time. Moved, a couple of years ago. We, as Venkat Garu was mentioning, we have a community there. We are helping the folks in Chicago area as well as other parts of the U.S. So we help individuals and businesses with their tax, wealth, and business management needs. So on the individual side, we help them with the wealth management as well. And on the business side, we help them to incorporate the companies, run the business, increase the bottom line, increase the profits, help them with the tax compliance as needed. So that's a short introduction about myself. So today I will be talking about Joe Biden's tax update for 2021. So how it's going to impact you, as well as a little more about the stimulus payments. People are a little confused about, I received the first check, I did not receive my second check. Would I be receiving? What if I've received in excess? Do I have to, give it back? So let's talk about these two topics today a little bit. And if you have any questions, go ahead and shoot it in the chat area, and Srikanth will help us moderate those questions as well. Thank you.
Srikanth, go take it over.
Krishna Rangaraj Garu, please give us your life insurance advisors to us and educate our TAGC members. And how do they want to help their family members so that they will feel comfortable in the future if there is any unfortunate events happen. So please give us advice and your expertise in the life insurance coverages to all of our audience, please.
Yeah. So I always advise, we all like me, every family, everybody who came to US with big dreams. As I said earlier, you can dream any big. So I am here to protect your dreams. Like from basic life insurance to protect your home, to protect your kids' college, and to protect your retirement, to protect your taxes in future. These are all four major areas where I help my clients. So minimizing the taxes at retirement is one of the major areas, and legacy. Minimizing the tax at retirement and legacy is one of the major area where I help my clients who are well settled here, but who just came like H-1B just now 1 or 2 years, just they entered into this country, or just some people. Most of the problem I see in the people, in the NRIs, not in the people, in the residents, like who just came within a year or two, and they are F1 visas or student visas, and most of them are H-1B visas also. Some unfortunate thing happens. The minimum thing, Srikanth, what I advise them to have is, something happens, their family needs to be protected if they are married. Otherwise also, there's a minimum requirement of at least $250 to $500,000 that comes very cheaper. Maybe $25 to $30 a day can protect them for $250,000 to $500,000 insurance. That is called term insurance. That's the basic way of protecting their life. I strongly encourage all the community leaders, encourage all the students, all the new H-1Bs or who are H-1B, they protect their families and their loved ones with at least a term insurance. That is the minimum. $1 a day can buy them $500,000 insurance.
So less than a Starbucks a day, you're saying?
Oh, Starbucks is, I think, I don't go much, but it is about $3. You spend a coffee. So, many people, even students, They spend every weekend, I think they spend some good amount of money on their entertainment or anything during the weekends. So $30 is not at all a big thing to protect for $500,000. I have seen Venkat, you and me are in these community events and helping the community. Every now and then I see people, somebody pass away. It's very unfortunate. I know it is a lot of emotion the parents lose when they send their kids to America with big dreams. But unfortunately, somebody meets with an accident, somebody may diagnosed with recently, very recently, I have seen a 32-year-old guy on H1B. Yes, he was diagnosed with cancer. One of the worst experiences I personally, one of my best friends at the age of 41, we both were at 42 age at that time. He was diagnosed with colon cancer and passed away. So recently I heard a couple more cases like that. So in these kind of things, people are not, they can't afford their family, couple kids, and you know how it's really hard to have enough money, unless of course somebody is rich over India, they have a lot of assets and all, but that is like self-insured. But 95% of the people are not self-insured with the needs. So those kind of needs can be filled with at least dollar a day. What do you think? Anybody who is on H1B, they may be earning more than $75,000 a year. So dollar a day should not be a big problem to protect their families.
Sure.
That is what my advice, and at least go with some term insurance. That is my basic advice to many things. Yeah, if they are well settled, they want to take care till longer. There are whole life plans. There are cash value plans where they can get back the cash, or there are so many other different plans. Once they can sit with me for at least they spend some half an hour time with me, whether it is virtual meeting or in-person meetings. But nowadays in-person meetings are not there anymore. But virtual meetings, I always go on Zoom and arrange virtual meetings. I'm sure they will be, I can advise them the best way of protecting their family's future.
Okay, this is more about you're talking about the younger generation who are coming to USA on H-1B visas. Yeah, I think that's many of our Indians who are not married. Actually, they are not even thinking about life insurance at all. I think that's a really important point which you brought here, because most of us actually do consider only, you know, once we have a marriage, once we get married and then we have kids, okay, then we'll think about, okay, we might want to protect our kids in the future. But I've not seen anyone even talking about life insurance who are coming to USA and still not married. I think it's a really good point that you're bringing here, because I think we need to encourage younger generation, especially who are coming here for studies, and on top of it, I think they are the high risk people, so they go to little risky areas in terms of when they are studying. They go to bad places, or sometimes work in gas stations, and also they might do some aggressive driving. You know, there are a lot of risk factors involved for all those young generations, but I don't think anybody is even thinking of that one. Probably we should, I think, Venkat, we need to educate our younger generation to consider the insurance policies, so that, you know, their family members in India feels much safer.
Yeah, nowadays many younger generation is coming, like, you know, they don't have enough money. I have come across with some cases where a guy dies due to accident, a student, for example. Some of the cases even do not even afford to send the body to India. Those are the situations. You know, a student who comes here nowadays, the parents are selling their lands, they're selling their retirement money, their everything, and sending their kids to higher education to US, thinking that, you know, culturally, a lot of Indian culture is like the kids are their retirement, kids are their long-term care, kids are their future. Right? For example, I have a couple kids, and for example, people think that, okay, I put all my money on my kids so that when I am old, they will take care of me. But as a kid, I'm as a H1 or what you call it as F1 visa, they are not married, but their parents are depending on their own kids. They're all future. They are investing on the kids, and something happens to their son here, and they can't even see the face. At least send the body. They request us. They call us so many times. It's so emotional. Even one particular time, there was nobody around me, and we couldn't take the body out of Cook County Hospital in downtown. It's about 15 years back story I'm talking about. So these kind of things, and there are a son and a daughter. Many times an Indian culture says, okay, my son, I put all my money on my son and send him to US, and he can send money. In turn, I can marry my daughter and look for a nice match for my daughter. And the son is responsible for so many other things in the family. Something happens, all the dreams are shattered. Anyway, the parents are losing a lot of emotion, but also a lot of financial value. That is what we need to protect.
Yeah, Krishna, I think it's fair points. Roy, I just want to go to your side. Do you want to take Q&A, or do you want to hit your slides first? I just want to.
If there are any questions at this time, we could do the questions. If not, I could go ahead with the slide share.
Yeah, I think I'm more interested in learning about the Biden's tax proposals, which you are mentioning. I think please go ahead and give us your details on that points, please.
Sure. Let me just try to share my screen.
Krishna, we'll come back to you probably after this presentation.
So you guys are able to see my screen?
Yeah.
All right. So I'll quickly run through the stimulus rebate questions we have, and then there's another set of slides on the tax law coming up with Biden. So as far as the stimulus rebate is concerned, let's look at, there were a couple of rounds of stimulus rebate. So we will look at that. We'll also look at what was the, income limits for those benefits. And, we look at if, people who have received unemployment benefits, are those going to be taxed? And there is a new cancellation of debt if it was related to primary residence. There were some changes to tuition deduction and things like that. We'll take a look at that. That's critical as well. And something related to charity as well. So in the interest of time, we will run through this quickly. And if you guys have any further questions, you could reach out to us. All right, so the rebate round 2 is for individuals and children under 17 who would receive like $600. Older dependents and non-resident aliens do not qualify, right? Older dependents older than 17 years old. And this rebate is based on 2019 tax return. And there is, of course, AGI threshold. If your income is beyond a certain limit, then you would not be getting those stimulus 1 and 2. All right, so if you have received either of the stimulus 1 or the rebate stimulus 2, those are going to be reconciled on 2020 returns. So many of them have question as to, I received one, I did not receive the second one. So if you have not received the second one, of course, we would be mentioning that on your tax return that you did not receive. And if your income permits, then you would be getting the credit on your tax return itself, right? So as far as the income is concerned, if you're single, if your income is between, if it's less than 75K, yes, you get the full rebate of $1,200 for the first stimulus and the second one of $600, right? If your income is exceeded by $87,000 for the second rebate, that's a phase out. If your income for a single person is more than 87K, then you would not receive the second rebate. So if you have not received one, then you'd know why you did not receive it. Likewise, if you're married filing jointly, if you should have received as $2,400 for the first rebate and an additional $500 for your child. And the second rebate is $1,200 and $600 for a dependent child. And the second rebate, there's a phase out, which is if you have earned more than $174,000, then you would not be, receiving the second check. Okay. So as I said, both these checks would go on to your, both these rebates, what you received would go on to your 2020 tax return, And the good news is that if you have received anything in excess, because let's say your 2020 income was higher and 2019 income was lower, and you received, those two credits, now you don't have to pay anything back, right? On the other hand, if your income for 2019 was high and you did not receive it, now if your income is lower for 2020, less than the 174 threshold, or for the first rebate it was 198 threshold. So if it was like less than that, you could expect something to come with your 2020 tax return filing. Let's quickly talk about some unemployment benefits. So 31 million workers received unemployment benefit in 2020. Of course, this is going to be taxed on your federal tax return. So the question always remains, this is unemployment benefits. Why should it be taxed? It is going to be taxed on your federal return, right? As far as state taxes are concerned, there's some variations. A few states like Alabama, Virginia, California, they are exempt states. So they don't really tax on your unemployment benefits. There are some states which are partially exempt, like Indiana and Wisconsin. And there are other states like, of course, there's no income taxes, like states like Texas. And all of the states which are not mentioned here would fully tax your unemployment benefits. All right, so with the COVID situation, some folks were not able to pay off their, primary residence mortgage, and probably it went into, if the lender did agree for a cancellation of debt, with this new regulation, that debt is not going to be considered as a cancellation of debt and taxed. So usually when you have a debt, and if that debt is canceled by the lender, then that becomes a taxable event and you end up paying taxes. Now, in this instance, you don't pay any taxes if it is your primary residence, right? Of course, if you had gone ahead and refinanced, then probably there is a situation of a taxable event in that scenario if the debt was canceled, if the refinance debt was canceled. There are some dollars limits. So this is a high level, review. If you have specific questions about your situation, do reach out to us and we can work with you on it. We used to have a tuition deduction on our tax return, and that's going to expire in 2020. So we're not going to get any more deduction for tuition, right? There are two other credits for education, which is American Opportunity Credit and Lifetime Learning Credit. So those of us who have kids going to college, we know that there's something called an American Opportunity Credit. And, now those phase out limits have been matched for learning credit as well as American Opportunity Credit. No big deal, just a quick information. Opportunity Credit and Lifetime Learning Credit. So those of us all right, so these are the standard deductions which are impacting us in the upcoming year, 2020 and 2021. Again, these are like increased for, cost indexation. And finally, we all know that the standard deduction was increased to, $24,000 during the Tax Cuts and Jobs Act during the Trump administration. And therefore, many of us were not able to get any deduction on charitable contributions. So for 2020 tax year, even though you do not itemize your tax return, you could still claim around $300 as cash contributions, even with your standard deduction, right? And that is going up to $600 if you're doing married filing jointly from 2021.
That's a good one, Roy. I think the 301 people forget because they donate cash donations to a lot of nonprofit organizations. Like I know, some of the audience is watching, and they donated for the COVID through to AGC. A lot of money. Whether through Facebook directly to us or they have donated. That's a good point. You're bringing it up.
Right, and the fact was, these deductions were not tax deductible because many of them were falling into standard deduction instead of itemized, because the standard deduction went up from $12,000 to $24,000. Now at least, and it's not a big amount, $300, but at least some deduction can be taken, which is nice. And for 2021, it is going up to $600, so that's even better for a married filing joint. All right. So, for all that we are talking here, there's this quick disclaimer about, because it all depends on your specific situation. So we may have to discuss more in detail before you make a decision based on what we discuss here. All right. So there's another set of information which I want to pass on. This is about Joe Biden's tax plan. But in the meanwhile, Srikanth, if there are any questions which needs to be taken, we could.
Sorry, I think I'm more. You talked about the Trump in 2020. We got a cash. So, do we need to declare that amount we received in the tax filing this year when we are filing the taxes? Is that right?
Right. So that's the idea behind. They want to, bring those stimulus 1 and 2. Even though the stimulus 2 was received in the beginning of 2021, they want to bring in both of those, and then reconcile that in the 2020 tax return, so that if somebody, as I said, if somebody had a lower income in 2019 and had a higher income in 2020. So the situation might be that, if you do the real math, they probably have to, pay it back. But, as per the rules, they don't have to. They can just keep it, because even though they had a higher income. But on the other hand, if they say they had higher income in 2019 and they were not eligible for either stimulus 1 or 2 because of the higher income, but let's say they lost their job and in 2020 they had a much lower income and they are fully eligible to get both stimulus 1 and 2, then that is where it's going to play out better for them. They would be able to get both those stimulus by including in their 2020 tax return. So these are not going to be taxable. Whatever they receive is what they keep. It's not an income per se.
Okay, thank you. I think we have Q&A session after we have all the points talk. Please go ahead with the Biden's tax plan. I think then we can talk about the Q&A.
Sure, sounds good. So there's going to be a huge change in the tax law based on Biden's administration. So we're going to talk about a little bit on the tax rates and social security taxes, capital gains and dividend for high income people. We're going to talk about qualified business income deduction, child tax credit and dependent care credit, estate tax exemption. So what we are going to look at is, with the Tax Cuts and Jobs Act during the, Trump administration, the tax rates, the highest marginal tax rate had dropped to 37%. So with Biden coming in, it's going to go back to 39.6%, which was as it was before. Now, this is going to hit people who were at the 37% tax bracket. So for example, if someone was making 620K married filing jointly, they would have paid 37%. Now with Biden's tax plan, probably they would end up paying 39.6%. All right. As far as Social Security tax is concerned, you all know that, beyond, if you make more than 137,700, you don't really pay any Social Security tax after that point. Now with Biden's tax plan, if somebody's adjusted gross income is more than $400,000, then they would end up paying 12.4% as Social Security tax on top of whatever income they make beyond $400,000. Okay, so the target here has been on high income earners. So $400,000 is what is considered as high income, and anyone who's making beyond that is going to see a huge difference in the tax liability with Joe Biden's plan starting from 2021. Now, capital gains and dividends, if you have income greater than $1 million, now, the capital gains and dividends would be, taxed at 39.6%, or the highest marginal tax rate, I would say, like your ordinary income. So if somebody were to be selling their property, and if they end up making a huge capital gain, Also, as you are aware, if you are a resident in this country, if you're a citizen, green card holder, or even on an H-1B, if you sell a property in India, you end up paying capital gains taxes here in the US as well. Of course, you get a tax credit for any taxes you may have paid in India. But yeah, so, we may see that $1 million is like, a lot of income, and we may have to, but if you're a physician, let's say you make $500,000, and then you end up selling your property and make another 600K as a gain, now you could see that all those gains are going to be taxed at 39.6%, which is the highest marginal tax rate. So a bit of tax planning would be needed to see how that should be handled. Another major impact is, as you're aware, the corporate tax rates used to be 35%. With Trump's tax law changes, it was brought down to 21%. And therefore, S corporations, partnerships used to get something called a qualified business income deduction, which is like, they could reduce their profit numbers by 20% and pay the taxes on the rest of the money, right? That's how it used to be with a 20% QBI deduction. Of course, many of our community members, either are involved in some way or form, either with an S corporation partnership. So what we need to remember is basically, if you're making more than $400,000, then the 20% deduction is going to go away, right? So, and the corporate tax rates are going to go up from 21% to 28%. And that's the reason why they want to change this QBI deduction, the qualified business income deduction for S corp owners, partnership members, right? So that's another major change. All right, so we're looking at the child tax credit is going to go up. Currently, it used to be like $1,000, and with the Trump changes, Trump tax law changes, it went up to $2,000. With Biden, it's going to go up to $3,000 per child. So that's really good news for many folks. And for children under 6, it's going to be an additional $600. It's going to be $3,600. So that's going to be good. Likewise, many of our folks, both parents are working, we send them to daycare. It was just capped at $3,000. I know many folks spend like $10,000 to $15,000 to send the kids to the daycare. And we always used to get a deduction of only $3,000 per child. Now, it's going to go up to about $8,000. Of course, there's an income cap and all that stuff, but the big picture is that, you're going to get about $8,000 credit. And they're planning to introduce a new first-time home buyers credit of up to $15,000. That's going to be interesting as well. So all these changes are not like final. These are expected to come up, but we can update you as and when the changes really comes through. All right. And finally, the last point here is about estate taxes. Upon a person's death, their entire assets are expected to be taxed for estate tax, right? So previously we had a $5 million exemption. So if somebody had assets worth $5 million, they don't pay any estate taxes. So if they had $6 million, they would pay estate taxes only on the $1 million in excess of the $5 million. With the Trump law, tax law changes, the $5 million was bumped up to $11 million, right? So, and husband and wife together could have not, they would not have paid any estate taxes if they had assets up to $22 million, right? So that was really nice. But with Biden's tax law changes, we're going to see that exemption is going to be capped at $3.5 million worth of assets per person. So if it's husband wife, of course husband can pass on all the assets to wife, and overall we're looking at about 3.5 plus 3.5, about $7 million of assets. So many of our community have assets outside US, and if you cap up all that, their entire assets are expected. So we could see that, and whatever is in excess of that limit is going to be taxed at 45%. Right. So that's pretty much from my side, Shrikant. So if you have any questions, I can take those questions.
So actually there's a question, probably it might apply to both. So while we're talking the estate tax thing, I know you mentioned the 5.5 million, the 10 million, and the 22 million thing. So Krishna, is that life insurance proceeds taxable, or does it come back to this estate what just Roy talked about?
Yeah, life insurance proceeds like death benefits are income tax free, but that includes into the estate of the deceased person.
Okay. Okay.
So, for example, I have $1 million and I gave my wife is my nominee. If I am not there in family picture tomorrow, my wife gets $1 million and doesn't pay any income tax on that. But when my wife is out of this world, and when we are inheriting our estate to our next generation, to our kids, all this becomes my estate. It is my estate actually.
Okay.
It
Okay.
is not it is not her income. It is in my estate.
So what just Roy talked about, it applies basically. As long as you're less than that number, you're good.
Yeah, less than that number. And what I suggest to wealthy clients is when you want to do estate planning, as Roy and me, I work with their CPA first of all. Otherwise, if they want to work on with the client directly, what I want is, paying taxes at both inheritance, lot of taxes. So instead of that, people can start funding the money towards life insurance so that something needs to be funded earlier. Otherwise, that will be taken out of your estate, right? There is $1 million estate tax. Where from people pay the tax? Unless you start funding that, something you need to be funded. Otherwise, all the tax goes out of your estate. For example, if I want to inherit this home, my home, and I have a couple other properties, which maybe, for example, I'm telling. So people have to sell that, and there is a limit. I think it is 9 months. Within 9 months, the children have to pay the tax, estate tax. So they will be hurriedly selling the stocks. Maybe the stock market is going low. Maybe they will be in a hurry to sell the home. Maybe the home market may be doing low. So it is always risky unless we fund the estate tax from the beginning. As we are making the estate big, we also start funding the estate tax so that the estate can be preserved. Otherwise, half of the estate or 1/4 or 1/3 of the estate goes into the taxes. What I want is that all that should go to my kids, right? Everybody, like,
Yeah.
not to the IRS. So I can start funding. The other way of reducing the asset is another way of looking at it. So I can donate. No, not donate. Sorry. Of course, donations are taken off. But what people can do is they can start reducing their asset value by gifting to their kids. I think it is about $25,000 each kid can be gifted, like each parent. So it's about $50,000. If we can afford, we can buy.
Yeah, the limit is $15,000, Krishna. So
Individual.
15,000 each. So they could do so for each child, they could do 15,000. So husband can do $15,000 for the first child. Wife could do $15,000 for the first child, right? Likewise,
Yeah.
they could each do like $15,000 for the second child,
Yes.
and they could do this like every year. So that's the interesting part.
Another
So
thing,
if
I work with many elite class professionals like doctors and business professionals. They have about 10, very common. It is having about 8 to 10, $12 million of net worth is becoming very common nowadays. It's when many Indians, particulars, I work with doctors and all, they just like that. But the one thing is, many people are interested to earning more, earning more, earning more. They put all their effort, all their time on that one. If they can take out little time, as little as 1 hour a week at least, or total at least 1 hour for their maybe year, maybe that can save them a lot of money in taxes, in all these kind of things. For example, as Roy was mentioning, yeah, it was 25,000. Now it is 15,000 each child. I can gift 15,000. Usually, 2 kids is the very common in our Indian cultural market. So 2 kids is about $60,000. Instead of putting that $60,000 in and making my asset bigger and bigger and bigger, I can put on my kids, and so that that is taken off as my lifetime gifts. That way, I can reduce some assets.
Thanks, Krishna.
Just one other point there, Venkat, to add on is basically when you do the beneficiary for the life insurance, it's always a good idea not to put your estate as the beneficiary, right? So instead, you would want to have the beneficiary as the person itself. So if a husband has an insurance policy, they would want to put the wife as the beneficiary and not the estate. And the reason is, let's say if somebody has got $5 million worth of term insurance policy, and if the estate is a beneficiary, now the estate cap would apply to that amount received as well.
Nice.
And it has to go through the probate and all of this stuff. Yeah.
Yeah, makes sense. Thanks. There's one question for Roy, but Shrikant, I will let you ask questions.
I do have one question to either of them who can answer. So you mentioned that 15,000 could be contributed for each child by each parent. So is that applies even the mom or one of the parent is actually a homemaker? Can they still, because she don't have income technically, right? How could she contribute, and could she even do that actually?
Right. So basically, it doesn't matter who is giving the gift. So it could be the husband who's the earner who is giving the gift to both the children, but the wife could also be included because it's called gift splitting, really. So as long as you're doing a married filing joint return, it doesn't matter. We are just going to split the gift.
Okay. So at what age we could start giving the gift for the kids?
But there's no age restriction as to the receiver, of the gift. You could start gifting at any time you want. And the nice thing is to do it like every year. If you want to remove your assets from your estate, eventually, the good idea is to, just start gifting as early as you can. And another thing, this can be done by grandparents as well. So if they're going to have a lot of assets and in the estate, they can gift it to their grandchildren. And they could also pay directly to an educational institution for, let's say, the college of the grandchildren, which then does not have a cap of 15,000. So if the kid is, the grandchild is studying for medicine, annually, the bill comes up to let's say $100,000, and the grandparent just goes and funds, directly pays the institution $100,000. That's a gift, which is not a taxable gift.
So another follow-up question on the same point. The kids don't need to file taxes for receiving the money from parents, right? As a gift tax, or do they need to file, or how that does even work?
The recipient does not file any gift tax return. Of course, if you receive a gift from a foreign person, which is in excess of $100,000, so if the grandparent is sitting in India and the child receives $150,000 into the child's account, or son, whoever it is, they will have to, file an information tax return. They don't pay any taxes on it, but they have to declare that they've received this gift, which is in excess of $100,000.
Interesting.
Yeah, I think there's one question from the Facebook side. Does the kid needs to be in any age? I think you answered, Roy, already. When you can donate to any age. So hopefully that answers that question. One other question I have is received from one of the younger audience is it better to do, I guess they recently joined a job, like 401k versus Roth 401k, or more like an IRA versus Roth for IRA? So in general, they're asking, should I lean towards one side or the other side? I know it's an investment advice, but however you can answer it, please answer.
Sure. So 401k is done through the employer, okay, and IRA is done on an individual basis, which is outside your employment. You do it on your own, right? So if your employer offers a 401k plan, you cannot do your IRA unless your income is really low, okay? So my advice would be that if your employer is offering a 401k plan, the best thing is to go ahead and do the 401k, which is like $19,500 of your income can be set aside towards a 401k plan, and which is basically tax deferred. You don't pay any taxes if it is a traditional 401k, right? So it's a good idea to do that. And secondly, the benefit is that your employer also would contribute to some extent to your 401k. So if you do not contribute to your 401k, then your employer does not contribute anything. So at least if you're not able to do the full amount of $19,500 of contribution to your 401k, I would suggest at least go ahead and do to the extent what your employer's contribution would match, right? So you don't want to miss that. So that's a misconception a lot of H-1Bs have, because I'm going to be here only for 3 years, 6 years, and I'm going to leave this country. Why do I contribute to a 401k? So, but at least you should contribute to the extent of your employer's contribution so you could get that benefit, right? Now, to answer your question about should they do traditional or Roth, so traditional grows, of course, you don't pay any taxes. Your income is currently tax deferred in the sense, to that extent, you don't pay taxes currently when you make the contribution, right? But the growth in the 401k will be taxed when eventually you take the money out at the age of 59 and a half or whenever that is, right? On a Roth, you end up paying taxes now, but the growth in the 401k is not taxed, right? So the decision really boils down to as to how much income are you going to have when you retire, right? So if you're going to have a large amount of income when you retire, you may want to do, a Roth 401k right now.
Okay.
But the usual trend or usual expectation is that people have lower income during their retirement, and therefore traditional 401k would probably be beneficial because they're saving on the taxes right now. If they're paying a tax rate of about 30%, they get a 30% tax saving right now, which probably is better than um, it all depends on the income during the retirement.
Okay, thanks. There's probably a follow-up question to that one. Can I open an IRA or Roth IRA for kids to save tax?
IRAs can be opened only with earned income. So somebody should have income really to contribute to, traditional or Roth IRA, right? So children probably, at the age of 14, 15, they start doing some part-time work. And let's say if they have, $10,000 or even $6,000 of earnings, it is a good idea to start off with so in that instance, you could go with a Roth IRA because you're not really expecting, any tax benefit for that child, right? You want that income to grow tax-free over the next, 50 years probably, right? So it's a good idea to do a, Roth IRA, and the income is lower, so they would be eligible. So it's a good idea to do that. But yeah, the point is they should have earned income. Dad cannot contribute, to the child if the child does not have earned income.
Okay, you can go ahead.
Yeah, the questions now is so to Krishna. So can you give us more detailed information on the differences between term insurance and whole life insurance and how it is going to help in different situations?
Yeah. Basically, those are the two major plans that is in the insurance industry, across in the insurance industry. But the term plans are generally temporary plans. You can choose how many years you want to be protected, like 10, 20, 25, 30, 35, 40, whatever, how many ever number of years. But that is a basic, simple way of protecting the family's future, certain number of years. And it is temporary, and it doesn't build any cash value in it, because it is like your car insurance, or it is like auto insurance, like car insurance. You pay, something happens, you get the money. Nothing happens, you don't. Again next year you pay the money, again next year you pay the money. For example, somebody takes a 20-year term insurance, and he lives beyond 20 years. All the money is gone. It is like a temporary plan, and you paid for it. You are very happy that nothing happened, and my family is protected for 20 years, which is very good. And it is very cheaper and very popular. It is a no-brainer to everyone. That is what I encourage everyone to take in the initial stages of our conversation. As Venkat mentioned, it's $1 a day, not even a Starbucks a day kind of thing. It's even Starbucks a day costs you about $2.50 to $3 a day, whereas this is just $1 a day. So can protect families in a bigger way. And whereas whole life serves a lot of other things, like it is permanent and you live for you pay for certain number of years and you don't pay anything, but it is like buying a property. It is there as long as you live. Like somebody makes it to even 100, there's a lot of death benefit that goes to the kids. And the way, as I mentioned earlier, this always go income tax free. Death benefits are one of the best advantages people are taking while they are insuring their life in cashback plans or cash value plans or whole life plans, whatever you call them. It is a whole life plan. So that way they can take the advantage of the tax benefit also. Like, for example, I always tell, if you are inheriting $1 million for assets to your kids, other assets, there may be a lot of tax implication. Whereas you are inheriting $1 million of your insurance, maybe that reduces, or some of the money can be used to pay the taxes, and the average may be decently good. Some asset you are paying tax, some asset you are not paying tax, so that that becomes averages out really good when your kids are inheriting the taxes. And it also can be cash values plans can be used for there is a way out that works, like they can take loan out the money in retirement, so that when they are loaning out the money from the cash value, so they don't pay any taxes. That way, that is another way of looking at it at retirement, minimizing the tax at retirement. That is one of the purposes many people, many elite class people, or those who can afford, they use this whole life plan.
Okay, what if I want to hand off and get the money back, let's say after 65, and I want to enjoy my money instead of keep that money in forever in that. So can we do that?
Yes, you have option to partial surrender the death benefit. Like when you are buying a property, you, for example, you paid 150,000 over the period of 20 or 25 years. You can take back your 150,000 and do whatever you want. You want to go around the world tour, or you want to stay at and keep going on world tour, or keep going around India, or whatever you want to do, you can do. But you can also keep some death benefit for as your legacy desire. So that way, you are having both sides of the coin in the same plan. You are enjoying what you save for, and you are also inheriting some of the money to your kids as your legacy desire.
And another question is that, let's say uh, you are suggesting that younger generation or who are bachelors still need to have a term insurance. Can they add their parents or family members who are in India as a beneficiaries?
Oh yeah, as I am coming across many people, like many students, particularly I want to focus on the new people who are entering into this country. Educate, educate, educate. The more number of people we can educate, the more number of families will be like safer back home. So that, as I said earlier, as I mentioned, I don't want to repeat all that story again, but everybody comes into this country with big, big, big dreams. Like I came with two, I have two kids and a wife, and that's a big dream. We left all our loved, even this is not the four people we love, right? Back home we have parents, we have unmarried, some of the young guys have unmarried sisters, and so many responsibilities, and all their parents must have sold all the assets, they minimized all the assets and put as their retirement on their son or daughter sometimes. So protecting that way, and their beneficiaries are in India, they can be in India or anywhere, and something happens here, the beneficiaries can claim from India. Actually, that is your straightforward answer. But yeah, that the dreams can be protected here. Yes.
So the
Just
another
to,
question.
Srikant, just to add one point on what Krishna was mentioning,
Mhm.
it is good to take the insurance early on. When you are like 25, it's going to be much cheaper to get an insurance, life insurance, than get it at 35 or 40, because as you age, then of course cholesterol kicks in or something kicks in, which will bump up your premium. So it's probably a good idea to take it early on. I guess Krishna would agree on it.
Yes, sometimes what at the younger age is we are very much insurable. One thing, we don't usually, people are very, very healthy. They get good rating and cheaper price. For example, sometimes parents are diabetic back home, or parents, one of the parents are diabetic. There is every chance, there's 50% chance that mother is diabetic and kids may be diabetic. Or there is 100% chance or 95% chance. I'm not a medical doctor to advise, but there's, if my father would have been had a diabetic, so there is about 100% or 90% chance that I may be diabetic. So those kind of families have more risk of diagnosis of diabetes. So when those kind of things are diagnosed, the premiums bump up, or sometimes the insurability also may get affected. So no company even gets insurance for those kind of people, and there's a lot of liability, lot of financial protection needed. That is where I help my clients. I can shop around for them and get any company which can accept them. I can insure them. Even right now, there are so many plans. Even I'm working on some cases who have been diagnosed with some cancer and that is treated well, and they can get some death benefit. There are some companies which issue minimum death benefit with no health questions asked. People do not have idea about all this. So anybody comes to me, I just try to help them out. At least if they are, even some people are diagnosed with cancer, and at least they can go with some minimum insurance. At least that can be used to send the body to India or to for final expenses.
Okay. The next question is Rai. So I think many of our immigrants who came from India actually are having kids who are like now teenagers, and some of them are actually thinking that their kids do not want to maintain their properties in India, and some of them are actually trying to bring their properties back to here because they are well settled here. So what are the tax implications, and how could they do it in a tax efficient way?
Yeah, that's a very good question. Actually, that's I've seen that trend pretty common as well. So that's a pretty good question. So the tax impact would be based on where the property is located. So if the property is to be received as an inheritance by the kids, then the tax liability will be lower. Okay, so I don't want to go much in detail. It's going to take a lot of time, but if it is received as an inheritance, then the tax liability is going to be lower for the kids. So if they have real old parents and they have these properties, it is written through a will that eventually the kids get it here. So that is better to leave it as a part of the will and get it as inheritance. But to answer your question, Srikanth, if they are like younger kids here, the property is owned by the US resident itself in India. And if they sell that property, the first impact of tax is to pay taxes in India itself because the property is located there. But of course, being a resident in this country, now they are supposed to be paying taxes on their worldwide income. So they would show the same property here as a taxable income for the capital gains, what they have gained over a period of time. Right. Now, if they paid any taxes in India, they would get a tax credit here, and they would still end up paying some additional taxes in the US. But of course, the exchange rate also plays in as well, because we would look at what in which year the property was purchased, and that will be the exchange rate we will be taking for the cost. Versus when it is sold, what is the exchange rate, and that would be the selling exchange rate as well. So a lot of things plays into it. So before they make any decision, it's good to go through a consultant, understand how exactly it is going to impact. Probably if they have multiple properties, they may want to stagger it over a period of time. They don't want to do all the properties in the same year. They may want to assess what their tax impact is going to be before they take those actions.
Thanks, Roy. Roy, there was a question from the audience is, I'm planning to buy a house. Is the mortgage payments any tax deductible, anything like that in that scenario? So can you quickly answer?
Sure. So, mortgage interest paid is one of the itemized deduction. So the interest only. So if you're paying any principal, that doesn't get into the itemized deduction. So with the tax law changes recently, we had a couple of years ago now, up to $24,000, you get it as a standard deduction. So your interest income should, and the property taxes, what you pay, both put together, along with some charitable contributions and all those stuff, would have to exceed that $24,000 limit for you to really benefit.
I see. Okay. Shrikant, we got about 10 minutes left. Again, on a Valentine's Day, I don't want our speakers and the audience to stay long. Again, the goal is educate the audience. Again, if there's any questions, please reach out to them directly. I mean, they have their own businesses and they can provide the service on that one. Again, the overall goal for today is if we can get rid of one GoFundMe event, I think we achieved the goal. I think, again, GoFundMe is a good thing. Again, nothing wrong on that process, right? But at the same time, if you do your own improper planning and you want your loved ones to do GoFund for you when you are not there, I don't think that's the right thing. So if you can get rid of one GoFundMe campaign, I think that's a good thing from this seminar. So Shrikant, go ahead.
Yeah. Thank you for having, for giving us your lot of details to both Rai and Krishna. Thank you very much. I think we will be definitely reaching out to you guys. I think in the future when we have more questions, and I think I know Rangaraju for a very long time, and I think I'm already using his services for quite a while. So yeah, it's pleasure to work, have services who knows our background. And the same way, I think Rai is going to help a lot of us here who could understand our situation and provide the services which suits for our needs. The same way for Krishna Rangaraj Garu. Thank you for being here and giving us a lot of insights and advice to us. Thank you, Rai. Thank you, Krishna.
Yeah.
If audience has any further questions, they can send it to questions@tagc.org and we will pass on to Roy or Krishna as applicable. Again, Roy is Nexus Management. You can easily search by indiancpa.com. I think that's the best way you can hit on his site and reach out to his office. Krishna, again, anybody ask in Chicago should give you Krishna's number if you don't have it.
224-875-1990. That's again 224-875-1990. That's my mobile number, and you can reach me out there.
Thanks, Krishna.
Yeah. Thank you, TAGC, for organizing and giving us an opportunity to give some insights and all these things. I'll answer all questions. Hope I answered all the questions up to the level of your audience. And if they have any more questions, they can always reach out to TAGC or to me. Thank you very much.
Right, go ahead.
Thank you.
Thank you, Shrikant. Thank you, Venkat Karu. It's always great to be associated with TAGC. It's been a long association, so look forward for many more years to come. And of course, if your audience has any questions, they could reach me at, as you said, they could go to indiancpa.com or, call us at our office, 1-800-601-7602. Right. Thank you very much.
Thank you.
Thank you. Thanks, everyone.